Hello everyone, so today I'll be sharing about how to select the best dividend stocks. What are the criteria that you should take into consideration when it comes to your selection? So first of all, dividends are rewards that are distributed to shareholders out of a company's profits. Each company has its own dividend policy. So say a company decides to declare 3 cents of dividends per share, and if you hold 100 shares, you will be entitled to get 3 cents times 100 equals to 3 ringgit worth of dividends. Now, there are a few types of dividends. There is the interim dividend, which is usually declared following the release of interim financial statements like quarterly earnings results. Then there is the final dividend, which is usually declared following the release of annual financial results. Now, generally, the final dividend tends to be more significant than the interim dividend because the company's management may tend to be more conservative before it gets its annual financial accounts. Now, there is also the special dividend, which is declared by a company, say, if it experiences an abnormal increase in its profits, which may be one-off, or say it just sold off a big asset and experiences a huge capital gain that it decides to share with its shareholders. After a company's board of directors declares that it will be paying out dividends to shareholders, as long as you hold the company's shares before the X dividend date, you will be entitled to get the dividend. Now, the dividend will be credited in the form of cash into your bank account on the dividend payout date. However, you can also opt to reinvest the dividends and use the money to buy more of the company's shares instead, thus topping up your holdings of the company's shares if you believe that the company can grow further and that you can make a better capital gain on it. Now, when it comes to dividend stocks, there are a few basic terms that one should understand. First of all, it is the dividend payout ratio, which equals total dividends divided by total net profits of a company, and it also equals to dividends per share divided by earnings per share. So this ratio shows the percentage of net profits that a company decides to distribute as dividends to shareholders. There are some industries that tend to have higher dividend payout ratios compared to other industries. Companies that have strong and stable cash flows and are in industries that are maturing, they do not need to reinvest much cash into growing their operations, so they tend to be able to give out more cash as dividends to shareholders. Take, for example, utilities companies. Now, no matter the state of the economy, whether the economy is booming or in a recession, people still need water and electricity, and they will still fund their bill payments consistently. So those earnings will not fluctuate much for utilities companies. So they're able to pay out strong and stable dividends over time. Then you have the REITs, the real estate investment trusts, which invest in properties. Now, REITs, they have to give out 90% of their net income as dividends to shareholders. If not, they would be taxed by authorities. So generally, to avoid getting taxed, they will pay out the 90% of their net profits. Now, the next term is dividend yield, which equals to the most recent financial year dividend, or the trailing 12 months dividends, divided by the current share price of the company. So generally, investors would like stocks with high dividend yields. This means that I'm getting a lot of dividends for the price that I'm paying for the share. But a high dividend yielding stock is not always optimal. You need to find out whether it is high dividend yielding because dividends are high and have been growing over time, or the high dividend yield is because the share price has been dropping due to a decline in the company's fundamentals. So we have to avoid being caught in the dividend trap. So why invest in dividend stocks? Well, first of all, dividend stocks can give you more attractive returns than fixed deposits. Not only do you earn your regular cash dividends every year, you also stand to benefit from an increase in the share price. So you get your returns in the form of dividends as well as capital appreciation. Secondly, when it comes to investing in the stock market, dividend stocks represent a safer choice compared to growth stocks. So companies that tend to regularly pay out dividends tend to have strong balance sheets with valuable assets. They have a large cash balance and strong and stable cash flows that tend to grow over time. So during an economic downturn, they are less likely to get into financial trouble. Now, growth stocks like technology stocks, they can give you high returns over time. But at the same time, they're also more volatile. And some of your technology companies, they are not profitable and they do not produce stable cash flows. They do not have a stable track record, so they represent a more risky form of investment. So it really depends on your risk appetite. You can choose to perhaps apportion your portfolio in such a way that you put 30% of your money in growth stocks and 30% in dividend stocks, or however mix you want it to be, depending on your own investment goals, your time frame, as well as your risk appetite. Now, thirdly, dividend stocks provide you with a margin of safety. When there is a recession, the stock market will experience a decline in most stocks across the whole market. But for dividend stocks, the share price decline can be mitigated by the presence of dividends. If the share price falls to a point that the dividend yield rises such that investors find the dividend yield attractive, and if the share price decline is just due to a temporary economic downturn, which does not cause the company's fundamentals to deteriorate over time, then investors will still choose to support that company by buying the company's shares to get that high dividend yield. So any share price drop will gradually be mitigated and it can support the company's shares such that a decline in share price would not be too drastic. First, we can look at a company's income statement to see if it has been growing and growing profitability at the same time. Look at the top line, revenue. Has it been growing consistently across the years? What about net profits? It is no use if the company is just spending a lot of marketing or other operating expenses to drive sales, but those sales are not translating into profits, because dividends are usually only declared if the company is profitable and continues to grow profits over time. Next, we look at the company's dividend track record. Has the company been increasing its dividend payout ratio or dividends over time? Now, a company generally will simply increase its dividend payout ratio if it is not confident that it will be able to maintain that ratio over time. Because, say, if a company suddenly declares a high dividend payout ratio this year and later on it decides to cut dividends, then shareholders will take this negatively and think that perhaps the management is not confident that it will be able to generate enough profits or cash to pay the higher dividends. We also want to look at whether the company has cut dividends before. What happened during the times of economic contraction? During recessions, during a bad time, like during the pandemic that happened last year, have dividends been cut? Or do the company's management still continue to pay out dividends because it still has a large cash balance on hand and is still optimistic about the company's future? Next, you want to look at the company's cash flow statement. Look at the cash flow from operating activities, which shows you the amount of cash that the company is able to generate from running its day-to-day operations. It is no use if a company is profitable but not generating cash flow out of its operations. It still won't be able to pay dividends that way. Next, you want to look at the cash flow from investing activities. This tells you what the company is spending cash on, maybe investing in new equipment, buying a new factory or a piece of land. Generally, in industries which are more mature, whereby the company does not need to spend too much on investing in growth, then it will have more money left over from operations to pay out dividends instead of spending on capital expenditure. You also want to look at the cash flow from financing activities. Now, this tells you how the company gets its finances, whether it issues new shares or it gets a new bank loan. And it also tells you whether the company uses its spare cash to pay out dividends to shareholders or do share buybacks. Now, we do not like it too much if a company raises debt just to be able to pay out dividends to shareholders. We would prefer that dividends are paid out of cash flow from operations and that the company is not often raising too much debt. Next, let us look at the company's balance sheet to see if it has a lot of valuable tangible assets like useful property, plants, and equipment that can fetch high prices in the market if the company needs to sell off these assets in order to finance its operations or its debt. Now, it also gives investors comfort if the company has a strong and growing cash balance, as a company that has a lot of cash will be less likely to get into financial trouble and become insolvent. Then you also want to look at leverage. If a company has excessive leverage, meaning that it relies too heavily on debt to fund its operations, then it can be quite dangerous. So one way to look at this is to look at the debt to equity ratio. If the debt to equity ratio is below 0.5, a company is considered to be safe. If the debt to equity ratio is above 1, then generally it is considered to be more risky unless it has a lot of cash flows that can cover its debt repayments. Now, have you started investing in dividend stocks yet? If not, you can explore and start your investment journey by opening a brokerage account and also a CDS account. So personally, I'm using Rakuten. So if you want to open a Rakuten account, feel free to check out the description section below, whereby I have included a link for you to open your account, and you can open your account online straight away without submitting any paper documents. So it is very easy to do so. So that is all for today. I hope that you have learned how to invest in dividend stocks yourself, and I hope that you'll be able to benefit financially and be able to hit your financial goals in time. Thank you for listening. Don't forget to like my video and also click on the subscribe button and turn on the notification bell for more videos like this. Alright? Thank you for listening. Take care and stay safe.